Hello everyone, welcome back to All Financial Discussion channel. For this video, I'm going to show you to you how can we actually apply ROE, return on equity, to Singapore three largest bank, DBS, OCBC, and UOB, and from there we can conclude that which bank is actually the best investment currently. So this is actually the objective of this video. So besides using the trailing 12-month ROE, I'm also going to implement the 10 years ROE to further prove that which bank in fact will be the better buy. So this will be the objective of this video. Before I continue, guys, this is very important to me. I'd like to urge you guys to help me by like this video. Guys, it's free and it's just a few seconds. Help me press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer, this is not a financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you're willing to lose. With this, we are ready to kickstart today's discussion. Next, I'm going to explain why ROE in fact is a very important parameter to determine whether the bank is a good buy or not. Firstly, it's because of the performance measurement. So what does this actually mean? ROE in fact show how efficient the bank management actually use this equity capital. So basically our shareholder equity to turn into profit. They actually can be indicated by ROE. So in short, the higher the ROE, it is simply better. So basically, as you mentioned here, higher ROE typically indicate better performance. Next, with ROE, we are able to determine the stock valuation and also how attractive this stock is to the public. So investors actually use ROE to compare banks against peer. Like I mentioned earlier on, it is quite so-called unreasonable to use just one parameters. For example, for this case here, ROE, for example, onto DBS Bank to determine whether it is a good buy or not. It is always very useful to use the same parameters on the bank and also against their peer. And from there, we can draw a conclusion whether this bank is still a good buy or not. And again, the higher the ROE, that will be better because they actually translate to a higher bank stock price and also higher valuation. Next is what we need to be very careful. So influence of leverage. While a high ROE, which means that this ROE, which is a big number, they actually indicate how efficient the bank management actually use our equity to turn into profit. However, banks often rely on substantial debts. So deposit for bank is in fact considered as debt. This can artificially inflate the ROE. Let me explain. So basically this is actually the debt. For example, for bank, deposit is considered a debt. So basically when there is actually monopoly on in terms of the debt, this number become very big. So the total asset minus the total liability, which is a big number, this become very small, which means that the shareholder equity become a very small number. When this shareholder equity become a small number, the profit divided by a small number, this actually will result in a large number on ROE. And therefore, we need to be very careful, because for bank deposits is actually considered as debt. So therefore, ROE should be evaluated alongside of return on asset in order to have a better assess a bank financial health. Next, I'm going to show to you how can we actually find the ROE of DBS Bank. So I want you to keep this in mind. You can actually use this same technique to find the ROE for OCBC and UOB. But over here, I just want to make it easy for you. I just apply this ROE onto DBS. So this is actually the data that you actually can obtain from the annual report of DBS for the financial year of 2025. So the net income, which is around 10.93B, and the shareholder equity, which is around 68.87B. And from the formula, okay, basically the ROE formula, which is equals to the net income divided by shareholder equity. And from here, you can compute that the ROE, okay, which is 15.9%. Okay, so basically this is actually the DBS ROE for the financial year 2025, around 16%. So what can we actually conclude? Okay, so basically for every $1 of shareholder capital, DBS is able to generate about 0.16 in profit. Okay, so this is considered quite strong for bank. Okay, because for typical global bank, the ROE is around 10 to 12, while DBS is around 16%. However, this is actually slightly below the 18% peak, which is recorded in 2024. This is partly due to the interest rate and also the margin pressure. Okay, so this is a simple conclusion on ROE on DBS Bank. Next, let me explain applying ROE on DBS, OCBC, and UOB. This is actually the outcome of the ROE on the three Singapore biggest bank, DBS, OCBC, and UOB. Okay, so this is actually for the financial year 2025. What can we actually conclude? Okay, so like I mentioned earlier on, okay, for DBS, ROE of 16% is considered relatively positive. This is possible because they are actually supported by record income. Okay, based on last year, they actually has a record income and also the strong wealth management growth. So this is actually the case for DBS. Let's discuss a little bit more on OCBC and UOB. Okay, so for OCBC, most of the time they are actually slightly better than UOB. They are actually quite close. Okay, but if you still remember, for global bank, it's actually in between 10 to 12% of ROE. So for OCBC, which is around 12 to 13%, this is also considered positive. Okay, so basically for the first half of 2025, in fact, it is around 12.6%. This actually reflects softer net interest margin and also the ongoing investment spending. Next, for UOB, like I mentioned earlier on, UOB is actually quite close to OCBC. They are probably offset by a very little percentage. From here, you can see that they are only less than 0.3%, okay, as compared to OCBC. This is also considered very positive when you actually compare against the global bank. Okay, so slightly below OCBC due to slower earning momentum and also higher capital buffer. So basically, before I go into the 10 years ROE, okay, I'd like to urge you guys to help me by like this video. Guys, help me press the like button now. Okay, if more you guys actually help to press the like button, this video will have a better chances to reach out to a larger audience. So guys, help me press the like button now. If you had learned something from this video, I urge you to support me by subscribing to this channel and turn on your notification bell. Once again, thank you so much for some support. This table here shows the 10 years ROE for DBS, OCBC, and UOB. Okay, so basically from the year 2016 all the way to 2025. Let me give you some insight. What can we actually conclude based on this 10-year ROE? Okay, so firstly, DBS has structurally higher ROE. So since 2022, okay, so basically since 2022, DBS moved into the 16 to 18% of ROE range, which is significantly above the peer. Okay, so if you keep this in mind, okay, when the report for 2023 is basically based on the 2022 performance. So from 2022 onward, DBS has been around 16 to 18% of ROE, which is considered quite high as compared to the peer. This is because they are actually driven by stronger fee income, digital efficiency, and the region wealth business. So this is one key insight. The second one, okay, OCBC and UOB, they are in fact very close, okay, very little apart from them, both typically around 10 to 13 ROE in normal condition. However, for OCBC, they are occasionally slightly higher okay, because of their insurance arm, Great Eastern contribution. Third, okay, at the 2020 pandemic dips, okay, so basically you can see that some form of pandemic dips, okay, all three actually show the ROE actually fell around 7 to 9% due to loan loss provision and also the weak lending. Next, okay, the rate hike, okay, so basically interest rate, okay, around this zone here, 2022 to 2024, is always consistent, very high. Okay, the rising interest rate actually boosts the net interest margin, and therefore, because of this, bank actually has a record profit, and this indirectly also lift the ROE across the sector. Coming to my last slide for today's presentation, key takeaway. Okay, so DBS always consistently has the highest ROE as compared to OCBC and UOB. So therefore, for DBS, it's always very attractive based on ROE. Like I mentioned earlier on, OCBC and UOB, they are actually very close apart. Typically, for OCBC, they can be slightly higher than UOB because of their insurance branch, Great Eastern. Second point here, the ROE gap actually explains valuation premium. Okay, so in fact, DBS command higher market multiply due to efficient and also growth. Third, pandemic and rate cycle actually impact all banks. From the year 2020, they actually dropped, while for 2022 to 2024, they actually surged because of interest rate remain consistent high during the year from 2022 to 2024. Last but not least, for investor, the ROE, in fact, is a very quick measure in terms of profitability per equity dollar. Higher ROE usually indicate better capital efficiency and earning power. With this, I'd like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.